And now, an Envision Financial podcast with Luke Smith on Canberra's 2CC.
Luke Smith from Envision Financial Services. How can it be Friday again already?
I'm not sure, but they're whipping by, aren't they? Holy cow.
Speaking of whipping by, have you seen the eucalyptus leaves outside the window? It's getting a bit windy out there, isn't it?
It's someone from they've got a $98 million website. Maybe they can tell us. Maybe they can tell us it's the windiest November in history.
Oh dear! Did you see that there was an IT firm, I think, in Melbourne that knocked together how a website should be done just for fun one day to say, "Hey, look, you could have done this."
You could have done anything. It's similar to your machete bins in Melbourne. Who sat down and worked this out?
And the fact that it's $98 million, even the most elaborate websites on earth, according to experts, shouldn't have cost any more than about 20 odd.
It is uncomprehendable.
It certainly is.
And yet people keep their job.
Well, it remains to be seen what the ultimate fallout will be. We'll see how it goes. Yeah. But the bloke at the top now, he's only just recently stepped into it. He's not the one that was responsible for this. He's just been left holding the bag as
he got rolled the hand grenade.
Absolutely. Today we have an interesting topic which has actually come up time and time again.
Yep.
And that question is this: how to avoid tax being taken from your super when you die? And of course, most people are going to turn around and say to you, hang on a minute, the money in super is tax-free after you turn 60. What's going on here?
Look, exactly right, and that's a wonderful segue into why are we banging on about this, because I'm getting tired of fighting people in my office who are adamant that this doesn't matter, I'm over 60, don't you know it's tax-free? Yes, love, I know it's tax-free. I've known it's tax-free for a very long time. But I'm not talking about you. I'm talking about your beneficiaries of where it's going to end up. And this misconception that all the money out of super is tax-free is not the case. So today we're going to break down really simply why, what is it, and how can I fix it?
Well, that's the important part, and we'll come to that in due course.
Correct.
But the thing that I think gets a lot of people confused is that, yes, we are told that our super is tax-free after we qualify.
Yes.
And that should be the end of the matter. And we also know that in Australia, we don't have death duties or inheritance taxes. And yet we've got this, which effectively amounts to exactly that, doesn't it?
It walks, talks, quacks, and waddles exactly like death tax.
Yeah. So how does it work?
Yeah. So when we work through our employment, we make contributions to super. And there's two types of ways you can put money into super. A taxable contribution, that's known as superannuation guarantee, salary sacrifice, personal deductible, and the earnings inside your fund each year from your return. They are called taxable components inside of super. On the other hand, we have a non-concessional contribution. And there are a number of others that would fall into the tax-free category, but let's not muddy the water with those. We can put money in and claim a deduction. We can put money in and not claim a deduction. Now, inside the fund, the superannuation fund every year sits down and says, okay, what's Luke put in? He's put in 30,000 taxable. He's put in 100,000 tax-free, or not at all. And the super fund runs a day-to-day balance because it's done on a percentage basis of your total. If all you've ever put into super is superannuation guarantee payments, some salary sacrifice, and the earnings in your fund, then it's highly likely that 100% of your fund will be taxable component. And any super fund will give you that over the phone, and some good ones will give it to you on the annual statement. That is what we are trying to fix for the next generation. Because a lot of people come in and they go, Luke, when I die, that's going to my kids. And I say, have you got kids? They go, yes, they're big kids. Oh, so by big kid, you mean over 18 and not a tax dependent? Yes. Okay. When you die, the super fund sits down and says, okay, what did Luke have in his fund? He has $100,000 and 100% of it is taxable component. It's going to nominees that are non-dependents for tax purposes, we will withhold 17% or $17,000 and give the kids the balance. That is why I'm stressing to mums and dads who are about to turn 60 or are 60 or are going to make contributions to super to think about how they do it and where they do it. So we need to look at the fund and say, what's the mix of taxable and tax-free? Now, if we take out $1 and let's say it's 50% taxable and 50% tax-free, we cannot say, oh, I want to take out just that bad component, right? We can't do that. If we take out $10, we have to take it out and the fund says, well, it's 50-50 taxable, tax-free. Okay, that's $10 coming out, $5 comes from tax-free, $5 comes from taxable.
Or whatever the percentage is that has been calculated by the super fund.
Exactly right.
Because it might be 70-30, it might be 80-20, it could be anything.
99-1.
Yeah.
Exactly right. So we need to understand what's the mix. Then what we say is, am I over 60? Have I got access to it? If the answer is yes, you would then want to think about the recontribution strategy that we've spoken about on a number of occasions. So let's keep the numbers round. Let's say we had $360,000 magically in our super fund and it's 100% taxable component. If I quit today at 60, I now have access to my super. I'm over 60, so I can pull money out on a tax-free basis. Now, the contribution rules where no deduction is claimed, we know are $120,000 a year or $360,000 in one go. And that means you can put it in and it's the year you put it in and you're locked out from making that type of contribution for 2 more years because you've just brought forward 3 lots of 120.
Yep.
If I had $360,000 in super, I quit, I go to my super fund and say, I've met a condition of release. They will say, Luke, are you over 60? Yes. Luke, have you quit gainful employment? Yes, I have. And I would like $360,000, please, paid into my personal bank account. Out it comes. So now we've pulled out 100% of the balance and 100% of the taxable component.
And it's come out tax-free.
Correct. Now, the next day, I could put $360,000 back into that account. And it's gone in as a non-concessional contribution, which means no deduction has been claimed, which means inside the fund now, it's treated as 100% tax-free component. So I've washed away the bad taxable. I've put the money back in, claimed no deduction, paid no tax putting it back in. So I've incurred no admin or transaction cost at the moment. And I can then say to the fund, I'd like to start a pension, please. And they say, sure, no problems. And then I start an account-based pension. The act of starting the pension is really important because it locks the percentage of that fund on the day the pension starts. So if I put it in today and on the 29th I start a pension, well, when I started the pension, the account was 100% tax-free. That means for perpetuity, that account will be 100% tax-free. Now, that could grow from $360,000 to $500,000, and I die and there's $500,000 in that pension account. Because it's all tax-free component, the tax liability that my kids will incur will be zero. So when we start to think about super being one of the largest assets that people have outside of their their family home, understanding this from an estate planning perspective as a parent is vitally important. And if you're coming up to retirement or you're in retirement, you need to understand this issue because your kids will thank you. Now, why do I bang on about it? I don't think the government spends our money well enough to give it to them for free. It is 100% death tax, just called something different. It is not widely understood that it is a problem because the misconception is, well, I'm over 60, it's tax-free to me. Yes, it is. We don't dispute that. But we also have to keep in mind that depending on the value of your fund, you may or may not be able to use that $360,000 limit because of your total super balance. So whilst I say you can take it out and put it back in that example, I had a balance of 360,000. Let's say I had $1 million. I take out 360. I go to put it back. Now, I would be thinking very long and hard about where I put it back. And you might put it into a new account. So now you have the balance of your existing account, $1 million. We pull out 360. We put that into another account and we start a pension. Now we've locked that component and we lock the balance of what's left. In 3 years' time, I can pull out 360 from the bad mix of assets, put it into the 100% tax-free pension, and keep repeating that every 3 years. Now, I bang on about this because at 75, the super doors are shut to non-concessional contributions. So you want to start doing this well before your 75th birthday, because if you do have the room, all things being considered, you pull out 360, put in 360, that's you locked out for 3 years. Now, if you've got 1.2, 1.3 million of all taxable component, you need some time to get this fixed. So another way around it could be, I pull out 360, I put it back into another fund for me. I pull out 360 and put 360 in for my wife. She may or may not have the same balance as me. She may want some more in her name, or it could be a great way to get taxable component out and tax-free into her name. So you need to be thinking about your collective positions, and don't be afraid to run two funds. This assumption that, two funds is bad, it's twice the fees, it's garbage. Because if you can manage the tax and control that at 17% for your kids, I can assure you that the administration on a second fund is not $17,000 a year on a $100,000 balance. So let's throw that one in the bin, along with plenty of other financial wisdom that, has stood the dawn of time.
All right. Now, when you say kids, a reminder, we're talking about adult non-dependent kids.
Exactly.
If you've got youngsters,
different story.
They will get the tax-free treatment because they're not because they are dependents.
Correct. Now, you could also, if you want to get in front of this, let's say you're 60 and still working, then you want to think about using the transition to retirement legislation. Yep. So I haven't quit work, but I want to start getting the taxable percentage down because I've got 1.2 million in my super. I take 120,000 out. I put 120,000 in a new fund. 1st of July, 120 out, 120 over here. Start a new pension. Now you've locked those components. And then we keep working with the balance that we have each year while we remain in the workforce. Another way, not perfect, but another way for people that want to be really prudent about how they manage it and start getting in front of it. Because if you've got a really big balance and your partner has a really big balance, it's going to be hard for you to do this. And then people say to me, well, why don't you just put the money back into the same fund? Yes, you could do that. But what did I say at the start? I said, when you take anything out, it comes out on a percentage basis.
Exactly.
So if we pull out the bad component and put good component back into the same fund, now we've gone from 100% taxable to 80-20. So now we take out $100. We're pulling out 20 of the good component we just created. Yeah. And we're diluting the effectiveness of this strategy.
Which is why a second account is better.
Exactly right. But we have to get over this assumption that, it's two accounts, it's bad, boo-hoo. No, it's really not. And your kids will thank you. But I want people to be aware of it because it kills me to think that this is just going by under the radar. And yet, as you say, we have no death tax in Australia. Well, 100% we do. We just don't call it that. And it's another grab on the way out after you've worked your whole life, you've paid your super contributions, you've paid earnings tax on your accumulated super, you've paid to put the money in there, and now they're going to take some on the way out? Not if you're sharp. And I want people to be sharp.
Luke Smith from Envision Financial is with me in the studio today, and we're asking how to avoid tax being taken from your super when you die. Of course, you're dead. You don't need to worry.
True.
However,
True.
If you want your beneficiaries to avoid the tax, here's what you need to remember.
So, 1, it's tax-free to you. It's not necessarily tax-free to them. Okay? Don't come in and fight me over the rules. It won't end well. Be proactive. As we said before the ad break, it's not something you can fix quickly, but it is something that you can fix strategically over time, and it's worth the faffing around. Now, this is also where you need to consider your non-concessional contributions and whether you've triggered the 3-year bring forward rule of $360,000, and you do that by putting in $121,000 in a single year. So understand your contribution history. Understand your total super balance. If you've got $1.9 million and the total super balance is $2 million, you cannot do $360,000. So understand your total super balance, because that will influence the amount of money you can take out and put in to fix this. Starting a pension locks the components the day after you've put it in. So if you take out the money, put it back into a new account, and it's 100% tax-free component, and you start a pension, those components are locked for perpetuity. If you don't start a pension, as we said before the ad break, the earnings will start increasing the taxable percentage, and you're diluting the strategy that you've undertaken. Remember that the money comes out on a percentage basis, and think about this. The money is glued to the component. People then say things like, well, I'll pay it to my estate, and they don't know where it'll go. They're going to tax it. Oh, I'm going to do it here and I'll do it there. And the money is glued to the components. The components travel with the money, and where it lands is then the impact of where it goes. Generally speaking, binding nomination to spouses, not a problem. Spouse is a tax-free beneficiary under the rules. No problems. Somebody predeceases somebody, and you've gone and got a good will done, and you've got testamentary trusts, and you've got a binding nomination to your estate, where's it going to land? First, let's control the percentage of taxable and tax-free, because that will save you and your estate tens of thousands of dollars, but you have to do it over time. You can do it multiple times. You can take it out and put it into a new account and do it the next 3 years for another 360. If you're 60 this year, you might do 120 before June, 360 in July, and you've just fixed 480,000. Now you've maximised the tax-free percentage for the next 3 years, and then you might do it again. Big misconception I get as well. But I've started a pension, I can't add to it. True. But nobody said you can't stop that pension. So you'd get to 30 June, take your minimum, go to your provider and say, I'd like to stop the pension. It goes back to superannuation, to accumulation phase. The contribution doors are back open. We pull it out from over here. We put it back in there. We start another pension. So don't let assumptions cost you tens of thousands of dollars in tax. Understand what you can do, because it is really, really important that you get in front of this, because it kills me when people walk in at 74 with 100% taxable. That happened this week, and you look at them and go, we can't fix this. If you'd brought it to me sooner, no problems. Oh, nobody told me. That's why I'm banging on about it, because I want all our listeners to understand, right, I'm going to check over the weekend with a glass of wine, what are my taxable components, and I'll log on and get an understanding of what I'm working with.
All right, Luke, it's that time of the day when I have to ask you, where can listeners get more information?
Yeah, office number 6260-4749, envisionfinancial.com.au on the internet, the Strategy Stacker Luke Talks Money on iTunes and Spotify, Envision Financial Canberra, where we've got a backlog of all the shows, and Smart Money Strategy, your ultimate guide to financial planning. It's an entire chapter in the book.
Fantastic, Luke. Thanks very much. We'll catch you again next week.
See you next week.
Luke Smith from Envision Financial, back again at the same time next Friday afternoon between 4:30 and 5 on 2CC.